Welcome back to the deep dive. We're doing something a little different today. Usually when we talk about derivatives, we are firmly seated in the cockpit.
Right.
We're looking at the charts, we're talking about delta, we're discussing volatility strategies, the stuff that makes the plane fly. But today we are going down into the engine room.
The engine room.
What?
Or maybe even the plumbing.
The plumbing, exactly. We are talking about accounting and taxation. Now, before you hit the skip button or decide this is the perfect time to go fold laundry, I want you to listen to me very carefully. Most traders treat this topic like the vegetables of the financial diet.
Yeah.
They know it's necessary, they know it's good for them, but they really don't want to chew on it. They just want to hand the paperwork to a guy in a suit and get back to the screen.
And that right there is the most expensive mistake a trader can make. Because if trading strategy is how you play the game, accounting and taxation are how you keep the score.
How you keep the score.
And frankly,
Yeah.
how you keep the prize money.
That's the hook. It's the difference between thinking you made a profit and actually having money in the bank after the government and the auditors are done with you.
Precisely. You can have a brilliant year in terms of raw points, raw P&L, but if you don't understand how those trades are recorded or how the tax man views a speculative loss versus a business loss, you might find yourself in a position where your winning season actually costs you money.
Or worse.
Or worse, triggers an audit you weren't prepared for.
So our mission today is to crack open this black box. We are digging strictly into Chapter 9 of the NISM Series 8th workbook, and we're going to decode the ledger entries. We're going to find out why accountants are professionally pessimistic.
We call it prudence, but yes, it feels like pessimism.
We're going to unravel the Great Shift of 2005, which sounds like a movie title, but is actually the reason you can offset your trading losses against your business income. And we are going to talk about the STT trap.
The STT trap is a big one. It's a silent killer for option profits.
So buckle up. We are turning the boring stuff into the most important stuff. Let's start with the mindset. Segment 1, the accounting mindset. The source material kicks off with something called AS11.
Right, Accounting Standard 11. Now, historically, this standard was designed to handle effects of changes in foreign exchange rates. But it gives us the fundamental framework for understanding how we treat forward contracts.
Okay.
And everything hinges on one word.
Which is intent.
Intent.
Yeah.
As in, why did I buy this?
Exactly. The accountant doesn't just look at the contract. They look at the motivation. They ask, are you hedging or are you trading? Because the mathematical treatment of your money splits down two completely different paths based on that answer.
Great. Okay, let's play this out. Let's say I'm running a textile company, Deep Dive Textiles. I know I need to buy $1 million worth of machinery in 3 months. I'm terrified the rupee is going to weaken, so I buy a USD-INR forward contract to lock in the rate.
Yeah.
That's a hedge, right? That is a classic hedge. You have an underlying liability, the machinery payment, and you are using the derivative to protect it. In this case, the accounting goal is stability. It's all about smoothing things out.
So how does the math work? How does it get on the books?
Well, there's usually a difference between the spot rate, the price today, and the forward rate, the price you locked in. Let's say the spot is 80 and the forward is 81. That 1 rupee difference is a premium.
A cost of doing business, basically. A cost for certainty.
Right. But because you are hedging, you don't take that hit all at once on day one. You amortize it.
Amortize. Break that down for me. What does that mean in simple terms?
Think of it like a slow trip. You spread that 1 rupee cost over the entire life of the contract. So if it's a 3-month contract, you take a little bit of that expense in month 1, a little in month 2, and the rest in month 3.
Ah, I see.
It's treated as an expense that matches the period of protection.
It's steady. It's boring. It doesn't cause any surprises on the quarterly report.
It's very boring. And that's what a business wants. They want predictable expenses. Any fluctuation in the actual exchange rate still goes to the P&L, but the cost of the contract itself is smoothed out.
Okay, now let's flip the switch. I'm not Deep Dive Textiles anymore. I'm just me, a proprietary trader. I have no machinery to buy. I just think the dollar's going to the moon and I want to ride the rocket. I buy the same forward contract.
Now, your intent is trading or speculation. The accountant looks at this and says, okay, you're not protecting anything here. You're making a bet.
Right.
And because it's a bet, we need to know the value of that bet right now.
So no slow drip.
No slow drip, no amortization. You don't get to spread out the premium. Instead, at every reporting date, say the end of the quarter or the end of the year, you have to mark that contract to its market value.
Mark to market.
Yes. If the value of the contract has gone up, you book a gain immediately. If it's gone down, you book a loss immediately. You recognize the volatility instantly because volatility is the whole point of your trade.
So, hedging is about shielding the books from volatility, and trading is about exposing the books to volatility for profit. That's the core idea.
That's the fundamental philosophical divide in accounting, and it dictates everything that follows.
That makes a lot of sense. But most of our listeners aren't trading currency forwards. They're in the messy world of equity futures, nifty futures, bank nifty. Let's talk about the accounting for that because this is where the terminology really trips people up.
It does, absolutely.
I open a trading account. I transfer, say, 5 lakhs to my broker. I call it margin. In my head, that money is spent. It's gone. It's the entry fee to the game.
And that is the first mental hurdle we have to clear in the eyes of an accountant and the law. When you pay an initial margin, you have not spent a single paisa.
It sure feels like I have. I mean, it left my bank account. It's not there anymore.
It feels like an outflow, but it is not an expense. It is a deposit. That money still belongs to you. It is simply parked with the exchange or the clearing member as a good faith guarantee that you won't run away if the trade goes against you.
Okay, so if I'm looking at my balance sheet, where does that 5 lakhs sit? Is it a debit, a credit? What is it?
It sits under current assets.
Yeah.
Specifically, you would open a ledger account called something like Initial Margin Equity Futures Account. It's an asset, just like the cash in your safe, except it has a restriction on it. You can't spend it on pizza, but it's still yours.
Okay, but here's a scenario. A lot of big traders, they don't give cash. They give a bank guarantee, BG, or they pledge their existing stock portfolio. If I give a bank guarantee, what's the accounting entry for that?
This might surprise you. There is no entry.
None.
Zero.
How can there be no entry? I've put up a guarantee for crores.
Because no cash has left your books. No
Okay.
asset has changed hands. You've just given a promise from a bank. In that case, you don't touch the balance sheet ledgers at all. You just make a disclosure in the notes to accounts at the bottom of your financial statements.
So it's just a footnote.
It's a footnote saying, by the way, we have pledged X amount as margin via bank guarantee.
That's wild. You can have massive exposure, massive risk, but if it's backed by a BG, the balance sheet numbers themselves don't move initially.
Initially, no. But then
Yeah.
the bell rings, the market opens, and prices start moving. Now we enter the world of daily settlement, the MTM.
The mark-to-market. This is the heartbeat of futures trading.
It is. And accounting-wise, this is where the action happens. Because unlike the initial margin, MTM is not a deposit. MTM is a realization of profit or loss day by day.
So let's walk through a day. I'm long Nifty, market crashes, I lose 20,000 rupees today. The broker debits my account. Is that an expense?
It is treated as a payment towards a loss. You would typically have a running account, let's call it mark-to-market margin account or deposit for MTM. If you lose money, you debit this account. If you make money, you credit this account.
So I have this running tally. Monday I win, Tuesday I lose, Wednesday I win big. The ledger is just jumping up and down with the market.
Correct. Now, let's fast forward to the most critical day of the year for an accountant. March 31st, the financial year end.
The day the music stops.
The day the accountant walks in with a very stern face.
Yeah.
Let's say you have a position open. You haven't sold it yet, but you have this running MTM tally.
Okay.
If your MTM account shows a net debit, meaning on paper you are currently losing money on this open position, the accountant looks at you and invokes the prudence principle.
I love this name, Prudence. It sounds like the stern school teacher from the 1800s.
It acts like one too. Prudence dictates. Anticipate no profit and provide for all possible losses.
So if I'm losing,
You must admit it immediately. Even though the trade is still open, even though the market could bounce back on April 1st, you must create a provision for loss right now. You take that hit to your P&L immediately for the year that's ending.
I have to confess my sins before the year is out, even if I think I'll be redeemed tomorrow.
Exactly. You recognize the loss.
Yeah.
But let's say the opposite is true. Let's say you are winning. You have a net credit balance. You are sitting on a fat 50,000 rupee profit on this open trade.
I'm popping the champagne. I'm booking that as income. It's a great year.
Put the cork back in. You cannot book it.
Excuse me. What do you mean I can't book it? The money is sitting with the broker.
You heard me. The prudence principle says you cannot recognize anticipated profit. Since the trade is not closed, that profit is not technically yours yet. The market could crash tomorrow and take it all away. So you treat that credit balance not as income, but as a current liability.
A liability. My profit is a liability. That makes no sense.
It's a liability because it represents money you are holding that you haven't fully earned yet in the eyes of a conservative accountant. It's money you might have to give back to the market. So you ignore it for P&L purposes. You don't pay tax on it yet, but you also can't show it to your shareholders as earnings.
That feels incredibly unfair. It's completely asymmetric warfare. If I lose, it's real immediately. If I win, it's fake until I close the trade.
It feels unfair to the trader, but think about it from the perspective of the company's survival. Imagine you book that paper profit. You declared a huge dividend based on it. You paid out bonuses to your staff based on that win. Then, April 1st, the market crashes. You lost all money, but you've already spent it. That is how companies go bankrupt. Prudence is the safety belt that stops you from spending money you don't truly have yet.
Okay, when you put it that way, it makes sense. It keeps us from getting drunk on potential. It's a sobering principle.
Exactly. It's designed to be sobering.
So that's futures. Let's pivot to options, because options are weird. You have this premium involved. It's not just linear movement. It's this decaying asset.
Right. In futures, value is linear.
Yeah.
In options, you have an asset, the right to buy or sell, which has its own life.
So let's track the money. I'm a buyer. I pay 10,000 rupees premium for a nifty call option. Where does that go? Is that a P&L expense on day one?
Not yet. When you pay that premium, you are purchasing a right. That right is an asset. So that 10,000 rupees goes to an account like equity option premium account, and it sits under current assets. You have swapped cash for a financial right.
And for the seller, the guy I bought it from, he got my 10,000. Is that his income?
For him, he received cash, but he hasn't earned it yet. He has sold you a promise. He has an obligation to you. So for him, that premium sits as a liability. He owes you performance if you decide to exercise.
Okay. Now let's bring our friend Prudence back into the room. It's March 31st again. I'm holding this call option. I paid 10,000 for it, but the market has tanked. That option is now worth only 2,000 rupees on the screen.
Prudence strikes again. You are holding an asset on your books at a cost of 10,000, but the market says it's worth 2,000. You have an impairment, a loss in value. You must create a provision for loss of 8,000 rupees immediately.
So I write down the value on my books for the P&L.
You keep the original cost in the ledger, but you offset it with a provision. The net effect is you take the loss now in this financial year.
And if it went up, if my 10,000 rupee option is now worth 50,000, let me guess.
You ignore the gain.
Of course I
You
do.
leave it on the books at its cost of 10,000, anticipate no profit.
I'm starting to hate this Prudence character.
Yeah.
Bad news travels fast. Good news waits for the doorbell.
That is the perfect summary. And for the seller, it's the inverse. If he sold it for 10,000 and now it's trading at 50,000, he is losing. It would cost him 50,000 to buy it back and close his obligation. So he has to create a provision for his 40,000 rupee loss.
Now, there is a practical question here. If I'm a high-frequency trader or just an active retail guy, I might have hundreds of open options positions at year-end. Do I have to do this calculation for every single contract individually? Option A is up, ignore. Option B is down, provision. That sounds like a nightmare.
Thankfully, no. The standards allow for global or composite provisioning. You can aggregate your positions. You can look at your total long Nifty options bucket or your short bank Nifty puts bucket. If the net value of that entire bucket is down, you provide for the net loss. You don't have to cherry pick every single line item.
That saves some sanity. Okay, before we leave the ledger and move to taxes, we have to talk about settlement, specifically physical settlement.
Yes. This changed a few years ago in India for stock options. It's a big deal.
Right. Index options are still cash settled. You just get the money difference. But if I hold a Reliance call option and let it expire in the money, I don't get a check. I get shares of Reliance delivered to my Daymat account.
Actual delivery. This is a crucial distinction for the accountant. It's no longer just a financial bet. It's a purchase of a real asset.
So walk me through the entry. I exercise my call. I have to pay the strike price to get the shares.
Correct. So you debit your equity shares account because you are receiving the stock as an asset, and you credit your bank account for the strike price paid. That's the purchase transaction.
But what about the premium I paid 3 months ago? That 10,000 rupees. Do I add that to the cost of the shares? Does it become part of my acquisition cost?
This is where it gets nuanced. Generally, in the trading book context described in Chapter 9, the premium's treated separately. The premium you paid is a sunk cost of the derivative transaction. When the contract expires and you get the shares, the premium balance is transferred to the P&L as a realized cost. The shares themselves come into your books at the strike price.
So there are two separate events in the ledger, the death of the option and the birth of the stock holding.
Exactly. You don't necessarily merge them into one super cost. Though, I will add a caveat. Tax professionals might argue for capitalizing the premium into the cost of acquisition for capital gains purposes later. But strictly speaking, for the trading ledger entries, they are often distinct flows.
Got it. Okay, we've booked our provisions, we've ignored our profits, we've settled our stocks. Now let's talk about the government slice.
The
Taxation.
world of Section 43.
The source material refers to the Great Shift of 2005. This sounds momentous. Why was 2005 such a big deal for traders? What were the bad old days like?
To appreciate 2005, you have to understand how bad it was before. Before 2005, the Income Tax Act had a very rigid, almost archaic definition of what they called speculative transactions.
Speculative usually implies gambling, like horse racing or lottery tickets.
In the eyes of the taxman, yes. Section 43(5) defined a speculative transaction as any contract for the purchase or sale of a commodity, which includes stocks, which is settled otherwise than by actual delivery.
And since derivatives were almost entirely cash settled back then.
They were automatically, by definition, speculative. Now, here is the kicker. Under Indian tax law, losses from a speculative business are quarantined. They're put in a little penalty box.
One hand.
Yes, if you have a speculative loss, you can only set it off against speculative gains. You cannot touch your other income.
I see the trap. So let's go back to my shoe factory example. I make shoes. I make a profit of, say, 1 crore selling shoes. But I tried to hedge my leather costs with derivatives, and I lost 20 lakhs on the hedge.
In the old days, that 20 lakh derivative loss was dead weight. You could not use it to reduce the 1 crore taxable profit from your shoe sales. You had to pay full tax on the shoe money, and the 20 lakh loss just sat there, waiting, hoping for a future derivative profit to offset it.
That's terrible. It basically punished you for hedging if the hedge didn't work out perfectly.
Exactly. It was a massive disincentive for businesses to use derivatives for risk management. It prevented the market from maturing. So the government realized this was holding back the financial system. In 2005, the Finance Act introduced a game-changing amendment.
The Great Shift.
The Great Shift. They said, effectively, if you trade derivatives on a recognized stock exchange like NSE or BSE, and it's tracked electronically with STT paid, it will no longer be treated as speculative business.
So what is it treated as now?
It is treated as non-speculative business income or simply normal business income, just like your shoe factory.
And the benefit of that is?
Freedom. Absolute freedom of set-off. You can now take that 20 lakh loss from your F&O trading and set it off against the 1 crore profit from your shoe factory, your consultancy business, or any other business income.
That is huge. So my taxable income drops from 1 crore to 80 lakhs. That's a massive tax saving.
Correct. And if you have a net loss overall for the year, you can carry that loss forward for 8 assessment years to offset future business profits. It normalized derivatives. It acknowledged that this isn't just gambling. It's a legitimate, integral part of the modern business landscape.
So for the vast majority of our listeners, retail traders, proprietary desks, their F&O income is business income.
Yes. Unless.
There's always an unless, isn't there?
Unless you are a foreign portfolio investor and FPI.
The big foreign money. The institutions, do they play by different rules?
Completely different rules. The government decided that for FPIs, securities held in India are capital assets, not stock and trade. They are seen as investors, not business operators in the traditional sense. Therefore, any gain or loss they make on derivatives is treated as capital gains, not business income.
And since derivatives usually expire in 3 months or less.
It is almost always short-term capital gains, STCG. You rarely see a long-term capital gain in derivatives because the instruments just don't live that long.
Okay, so FPIs pay capital gains. Locals pay business income. Now, business income implies something scary to the small trader. It implies audits.
The dreaded tax audit.
The source material throws around some specific numbers. 10 crores, 2 crores, 6%. It's a bit of a number soup. Let's strain this out. When do I actually need a chartered accountant to audit my books?
Let's look at the triggers. The biggest one, the hard line, is turnover. If your business turnover exceeds 10 crore in a financial year, a tax audit is mandatory under Section 44AB. No questions asked, you need an audit.
10 crores sounds like a lot. Most retail traders are thinking, I have a 5 lakh account, maybe 10 lakhs. I'm nowhere near 10 crores.
And that is where they are dangerously wrong. You'd be shocked how fast a 5 lakh account hits 10 crores in turnover. We'll get to the definition of turnover in a minute because it's deceptive. But first, the other thresholds.
Okay, what if I'm below 10 crores?
If your turnover is between 2 crores and 10 crores, there is a special provision. If 95% of your receipts and payments are digital, which, let's be honest, in F&O trading, it's 100% digital, nobody's paying margin with a suitcase of cash,
Right, it's all online.
then you generally do not need an audit. The government is trying to push digital transactions, so they give you a pass in this bracket.
Okay, so 2 to 10 crores is the digital safe zone. What if I'm a small fish? My turnover is less than 2 crores.
Then you have a fascinating choice. You can opt for something called presumptive taxation under Section 44 AD.
Presumptive. That means the government presumes something about my income.
Exactly. The government says, look, we don't want to go through your messy ledgers. It's too much work for us, too much work for you. Let's just make a deal.
A deal.
You declare 6% of your turnover as profit. We will tax you on that 6%. In exchange, you don't need to maintain detailed books, and you don't need an audit.
That sounds convenient. Here's my turnover, here's 6%, take the tax, leave me alone.
It is very convenient if you actually made a profit of 6% or more. But what if you made a loss? Or what if you made a profit of only 2%?
If I made a loss, I definitely don't want to pay tax on a presumed 6% profit. That would be insane. I'd be paying tax on money I never made.
Precisely. So if you want to declare less than 6% profit, or if you want to declare a loss, and your total income from all sources exceeds the basic taxable limit, which is 2.5 or 3 lakhs depending on the regime, then the deal is off.
The deal is off. What happens then?
You fall out of the presumptive scheme. You are basically saying, government, your presumption is wrong. I actually lost money. And the government says, okay, prove it. And the only way to prove it,
An audit.
a full tax audit. So ironically, the small traders who lose money are often the ones who strictly need an audit to claim that loss and carry it forward. You can't just claim a loss on a napkin. You need a signed audit report.
That is a crucial insight. So if you want the tax benefit of a loss, you have to pay the cost of an audit.
Correct. The audit is your ticket to claiming the loss.
Now, we have to solve the mystery we teased earlier. Turnover. In the stock market cash equities, if I buy shares for 1 lakh and sell for 1.1 lakh, my turnover is the sale value, 1.1 lakh. Simple.
Right.
But in derivatives, I don't own the underlying, I'm just betting on the difference.
Yeah.
So how do we define turnover? Is it the contract value? Because that would be astronomical.
It's not the contract value, thankfully. This is where the guidance note from the ICAI, the Institute of Chartered Accountants of India, comes in. They state that for F&O, turnover is the sum of absolute profits and absolute losses.
Absolute. That means we ignore the minus sign.
Correct. We treat every outcome as a positive number for this calculation. Let's do the math. Simple example. Trade 1. You buy Nifty futures.
Yeah.
Market goes up. You make a profit of 50,000. Trade 2. You short Nifty. Market goes up again. You make a loss of 40,000.
Okay, so my net P&L is plus 50,000 minus 40,000. I made 10,000 net profit.
Your net profit is 10,000, but what is your turnover?
Is it 50,000 plus 40,000?
Exactly. Your turnover is 90,000.
Wow. The loss adds to the turnover. That feels so counterintuitive.
Yes, because turnover represents the volume of business activity, not the result. The accountant views the loss as a negative cash flow that is still part of the business churn, the total value of the bets you placed.
This is the trap. Because if I'm a scalper, say I do 20 trades a day, I win 1,000 rupees on 10 trades, I lose 1,000 rupees on 10 trades. I might end the day with 0 profit, completely flat.
Right.
But my turnover would be 10 times 1,000 plus 10 times 1,000. That's 20,000 rupees turnover on a 0 profit day.
And you could easily generate 10 or 20 lakhs of turnover in a single bad day of overtrading. Do that for 200 trading days a year.
And suddenly I'm crossing the 2 crore limit, or even the 10 crore limit.
While having zero money in the bank to show for it.
That is terrifying. So a retail trader with a 5 lakh capital could accidentally trigger a mandatory tax audit just by churning their account too much.
We see it happen all the time. And then they get a notice from the tax department and they panic. But I didn't make 10 crores. No, but you turned over 10 crores of risk.
Listener, if you take one thing away from this segment, calculate your turnover the right way. Absolute profit plus absolute loss. Don't look at the net P&L number.
Spot on. It's a critical distinction.
All right, we have one final monster to slay. We've done accounting, we've done income tax. Now we have to talk about the silent cost, the STT securities transaction tax.
The tax you pay even if you lose. The ultimate friction cost.
It's collected at the source by the exchange, so we often don't notice it until we look at the contract note. The rate seems so small.
They are small, generally. For futures, the seller pays 0.02% of the traded price. For options, if you sell the option on the exchange, you pay 0.1% on the premium value.
Okay, 0.1% of the premium. So if the premium is 100 rupees, the tax is 10 pays. It's negligible. It's dust.
It feels negligible.
Yeah.
But There is a trapdoor, a very expensive trapdoor, and it opens when an option is exercised.
Exercised, meaning I hold a buyer position until expiry day and it ends up in the money.
Yes. In India, if you hold a long option position at the close of market on expiry day and it is in the money, the exchange automatically exercises it for you.
Okay.
In this specific scenario, the exercise of an option, the STT rules change dramatically. The rate jumps to 0.125%.
Okay, a small jump from 0.1% still seems tiny.
No, look closer. It's not just the rate, it's the base. The 0.125% is applied not to the premium, but to the settlement price, the full notional value of the contract.
Whoa. Stop the tape. Let me process that. Let's do the math. Let's say Nifty is at 25,000, one lot is 50. The contract value is what? 25,000 times 50?
Oh.
12.5 lakh.
Correct, 12.5 lakhs is the notional value.
So if I sell my option at 3:20 p.m. and the premium is say 100 rupees, so 5,000 for the lot, I pay 0.1% tax on that 5,000 rupees. That's $5.
Right, 5 rupees.
But if I wait until 3:31 p.m. and let it get automatically exercised, I pay very 125% on 12.5 lakhs.
Which is roughly 1,562.
So my tax bill went from 5 to over 1,500 just because I waited 10 minutes.
Exactly. And here's the STT trap scenario that wipes people out completely. Imagine your option is barely in the money. Let's say Nifty is 25,000 at expiry. You are holding a 24,990 on 90 call. It expires. You are 10 points in the money.
Okay, 10 points times the 50 lot size. I made a profit of 500 on the expiry itself.
You made 500 gross profit, but because it was exercised, the STT bill is 1,562.
So 500 minus 1,562, I lost money.
You have a net loss of over 1,000. Winning the trade cost you money.
That is absolutely brutal. You win the battle but get shot by the taxman on the way home.
It happens every single expiry. People forget to square off. They see their slightly ITM and think, great, I'll take the money. They don't realize the tax is larger than the profit spread.
So the golden rule here is what?
Square off. Always, always, always square off your option positions before the market closes on expiry day. Do not let them go to auto-exercise unless you are so deep in the money that the profit easily covers that 0.125% hit on the full contract value.
That is a wealth-saving tip right there. And just quickly, what about physical settlement? If I get the actual shares of Reliance delivered to me?
If it results in physical delivery, then the STT aligns with the standard equity delivery rate. It's 0.1% on the transaction value paid by both the buyer and the seller. It essentially morphs into a stock transaction at that point.
Okay. That feels consistent, at least.
It is. The real danger zone is specifically cash-settled index options that are exercised when they're only slightly in the money.
Phew! We have covered a massive amount of ground today. We started with the vegetables and ended up realizing they're actually the main course.
Indeed, they're where the real nutrition is.
Let's recap. If we had to put the deep dive cheat sheet on a Post-it note for our listeners, what are the 4 big takeaways?
Takeaway 1. Respect prudence. Understand that accounting forces you to book losses early, but delays your profits. Don't let that skew your view of your own performance, but respect it for cash flow planning.
Takeaway 2.
Margins are assets. Stop thinking of margin as a cost. It's a deposit. But remember, turnover captures the churn of your money, not just the result. Watch that 2 crore and 10 crore audit limit like a hawk.
Takeaway 3.
Taxation is your friend. Mostly. Since 2005, the ability to offset F&O losses against other business income is a massive shield. Use it. Don't hide your losses. Report them correctly with an audit if needed, so you can save tax on your other gains.
And the final one, the one that hurts if you forget it.
Beware the exercise trap. Never let a marginally profitable option expire. Square it off, pay the tiny tax on the premium, and walk away. Don't pay tax on the mountain when you only climb the hill.
Fantastic summary. You know, we spend so much time in this industry obsessing over the Greeks, delta, theta, gamma. We think they control the universe.
You do.
But at the end of the day, it's the accountants, debits, credits, and taxes that determine what actually hits your bank account to pay for your groceries.
Well said. The Greeks predict the market, but the accountants keep the final score.
So here is a provocative thought to leave you with. We talked about turnover being the sum of absolute profits and absolute losses. I want you to go download your ledger for the last financial year. Don't look at the net P&L. Calculate your turnover using the formula we gave you. You might find that you are running a multi-crore business without even realizing it. And if you are, ask yourself, is your infrastructure, your audits, your record keeping, your tax planning ready for a business of that size? Or are you running a Fortune 500 volume operation with a lemonade stand back office?
That is a question worth asking.
Thanks for diving deep with us today. Check those ledgers, watch that SDT, and we'll catch you on the next deep dive.
Happy trading.